Hello friends, and in this video I want to talk about how to put assets in a Canadian corporation without triggering tax. And this is about Section 85 rollover, which is in the Income Tax Act. And this whole video is triggered because one of my friends recently came to me and asked, Eric, I have many properties that I own and I would like to pass it down to my kids. What is the most tax efficient way to pass it down to my kids? So that's where Section 85 comes into play. So first, let's talk about the problem that my friend is trying to solve. So in Canada, there's inheritance tax. And what that means is that upon death, you will need to file a final tax return to CRA. So this is really one of the reasons why you might want to use this strategy, but it is really a good reason to plan early. So upon death, you will need to file a tax return to CRA. It is called right or things return. So in Canada, upon death, you have assumed to sold all your properties at the date of your death at fair market value, which means that if you have multiple properties under your name, it would assume to be sold at that price. And this would usually trigger a large tax bill for any rental properties or stock portfolio. Even if you actually didn't physically sell it, it is assumed to be sold. So just for reference, capital gain is 50% taxable in Canada, and the maximum tax rate is 50%. So that means approximately 25% of the capital gains are taxed. So when your family is passing down assets to you or to children, the children will usually have to sell some of the assets, whether that is stocks, bonds, or real estate, to pay for that large tax bill. So then the question is, well, is there any way to defer or delay the tax if you are able to plan early? Now, reducing taxes upon death is actually a complicated topic, and you should not try this yourself. You should always consult an accountant, a tax accountant, ideally. Now in this video, I'll explain one of the many strategies that can help change the way you organize your assets, which will reduce hundreds of thousands of dollars in taxes for years to come, especially upon death. So the solution is really in Canada, there's a special tax rule called Section 85 rollover. Most of the time, people who are looking to start their own businesses will use this rollover method to incorporate, meaning to start a company. So here's how it works. The goal of Section 85 rollover is to allow assets to be transferred into a Canadian corporation without triggering tax, which means you can put a bunch of assets into a corporation without tax consequences if you do it correctly. Now, if this mechanism did not exist, then assets needs to be transferred into the corporation at fair market value, which will usually trigger taxes upon a transfer. So for example, let's say you're trying to put a rental property into a corporation that is originally under your own name. So when you bought it 10 years ago, it is worth $1 million. Now, because you live in Vancouver, the property prices are crazy and the Canadian government has been printing money, so the property is now worth $3 million. So that means you have a capital gain of $2 million. Now, if you didn't use this strategy or Section 85 rollover, then you will have to put the property into the corporation today at $3 million. And CRA will dictate that you put it in as fair market value, and this would trigger a 25% capital gain tax, which is worth about $2 million times 25%, which is $500K or $500,000. And this will get you into a complicated situation because where are you supposed to generate that $500K to pay CRA? And that's really where Section 85 rollover comes in. Now with Section 85 rollover, you're able to elect the price to transfer into the corporation, and there are three options. So first, you can transfer the rental property at fair market value, which will then trigger the capital gain tax I just mentioned above. Or you can transfer it in at cost, which you don't trigger any capital gain tax. So that is usually the recommended number. And third is that you can choose to transfer at a number anywhere between fair market value to cost. And you get to select how much tax you want to pay now versus how much tax you want to pay later. So let's say you want to transfer it in for $1.5 million. You can do that. you just need to pay a little bit of taxes today, and going forward, the cost for the property will be 1.5 million. Now, if you transfer the rental property into the corporation at cost, then you don't need to pay any taxes when you put it in the corporation. When you sell the rental property 10 years from now, the cost will still be the $1 million, which is the original purchase price. So what this means is that you will still have to pay capital gain taxes when you sell it 10 years later in the corporation, but it is deferred until you sell the property. And that is really the key word, deferring taxes. And if you hold on to the property indefinitely, then, well, maybe you never have to pay property capital gain tax. Now, there are a couple of benefits when using Section 85. So first, you're not putting all the properties under your name. Now, if you get sued, then someone can, of course, try to grab onto your other properties as collateral that is under your name as well. For example, if someone is walking on your pavement and slipped because of snow, then they can sue you for damages for all the properties under your name. So that puts all of your assets under a lot of risk. Second, you can easily pass down the ownership of the property to your future generation if you have a corporation set up. When you set up a corporation, you can start adding other people in your family as owners of the corporation as well. Now, what this does is that you start giving a part of the ownership to your son or your daughter, and before you pass away, the corporation can actually take back your share, making your son and or your daughter the only shareholder in the corporation. And this will avoid selling the corporation as well, or the properties within it. Third, it is easier to split the income once you have a share structure in place. So, for example, you can add relevant family members onto the plan when you want to distribute dividend and income. It is much easier to do so when you have different classes of shares, so then you're not piling all the rental income under your own tax return. And finally, Section 85 works for any assets relating to your business. It can be a car, it can be equipment, it can be land, it can be properties. So when you roll it over, you can roll it over at cost instead of the fair market value. Now, of course, this video is just general advice on how you can save on taxes, inheritance, and there are actual technicalities you need to consult your accountant for before making a decision and set up the corporation properly. But at the very least, now you can approach your accountant and say you want to do a Section 85 rollover. So I'll see you in the next video.